Good evening, everyone. Thanks for showing up. I'm Debbie Schwartz, founder of Road to College and the Paying for College 101 Facebook group, and I am here tonight with Chris Abkarians. He's a co-founder of a company called Juno, and he will explain more about that. And tonight we're talking about how to pay for college, and also really getting into federal and private loans and helping answer a lot of questions, explaining how they work. And Chris is also going to talk about, which I think is really important for everybody here, talk about what might be coming down the road with changes that are happening in Washington. And your particular class is going to kind of be the bridge a little bit because you're going to have 1 foot in the world of how things work today and 3 feet because of 3 years potentially in the world of what might be coming. So it's important to understand what all those changes are, and Chris is definitely going to touch on that tonight. So Chris, I would love for you to introduce yourself, explain about a little bit about Juno and your background, and we will get started.
Thank you very much for the intro, Debbie, and thank you everybody for being here this evening. I'm Chris. I'm one of the co-founders of Juno, and I've become a reluctant expert on most things related to student loans. I needed a bunch of student loans for undergrad at Duke, and then I got into business school at Harvard, and I started Juno, which at that point was an experiment. I'll tell you a little bit more about it later, but the key thing to understand is I literally started the company for the purpose of trying to see if I could bundle together a few hundred of my classmates who needed to get loans and at the same time and ask lenders if they'd be willing to provide discounts to our group or different terms to our group than we could get on our own. It worked very well when we ran it as an experiment. And for the last 7 years, we've formalized it and run it as a company now for a little bit over 200,000 people. And so what I'm going to walk through tonight is a general overview of how all loans work for college and where Juno fits in that puzzle. And if there's one ask I can have of you through this, it would be to, if you're going to shop around, if you do need any loans, to consider checking Juno at some point in the process, because we have a special type of program that I think can make almost everyone the best off of the options that would be in front of you. For roughly the next hour, we'll go through the following agenda. So I'm going to very briefly touch on cost of attendance and some of the different ways to think about paying for college. These are topics that I think this audience in particular is more familiar with. And so I will go through some of this, but we'll spend the vast majority of the discussion tonight around a more comprehensive understanding of how undergraduate student loans work. And so we'll go through your federal options, private options, how to compare them, and how to think about which ones make sense for you. I'll give you just 2 minutes on how to get the lowest rates. And finally, throughout, I'll cover some of the key changes that may be coming from legislation that's currently out in Washington, but that has not yet passed. As Debbie was mentioning, those changes would impact things starting next year, the way that things are currently written, but it's important to understand now. If you have any questions as we go through, please feel free to use the Q&A or the chat box, and we'll pause along the way and try to answer them live. So just a little bit of context setting in terms of the overall timeline for financial aid and paying for college. We are right after the point at which most people have decided which school they or their children are going to attend. And tuition for most programs is due in August or September. Each one is a little bit different. And now is a great time to think about, okay, if you do need to get any extra funds in order to pay your upcoming student bill, what are the best ways to do that? So we're going to focus exactly on that topic. I'm going to go through this section a little bit quickly, but please do stop me if there's anything you want more color. So at a very high level, there's 3 ways that you can go about paying for the upcoming school year. And we're going to break them down in the following slides in terms of the free money that doesn't have to be paid back, some ideas around using your savings or ongoing income to pay towards the student bill, and where loans fit in the overall picture. If I do my job right, then hopefully you'll have a good grasp on the full cost of college, a brief overview on maximizing that free money and steps that you can take both this year and in future years, and a path towards figuring out how to borrow at low rates if you do need to borrow at all. So first slide that kind of matters here is getting a better understanding for what your student bill actually means. And I'm going to use an example through the rest of these slides. First, on this slide, we're going to build up to what is the actual total cost of attendance, and then we're going to break down to in what order you think about paying for it from different buckets of money. The example I'm going to use is just an in-state student at UCLA for the upcoming academic year. I randomly picked it. I didn't go to UCLA, but go Bruins. Mm-hmm. So cost of attendance is something that every school publishes on their financial aid website, and they typically update it once per year. It's made up of all the factors that you see in this slide. So this bridge is tuition plus fees, food and housing, health insurance, personal expenses, and books and supplies. And all of those put together equal your cost of attendance, which is effectively the sticker price to go to school for 1 year at a time. This doesn't represent a 4-year number. This number can change each year. And for many schools, it does go up 3 to 5% each year. So just something to keep in mind. Now, before we go into how to pay this, one just tip I want to remind everybody of is if you or your children are already covered by health insurance, then you can use a waiver at each school to remove that amount from the required payments. In this example, that becomes a fairly significant amount of the overall number. So you would subtract out $3,600 from this $43,000 cost of attendance, and it can make a big difference. So if your children do have health insurance coverage, which under a certain age that you do, they would, make sure that you're taking advantage of that waiver program. And just keep in mind that that waiver program is typically something that needs to be resubmitted each year. So now let's just get into breaking down that $43,000 cost of attendance. So I'm going to use this example and assume that the family with this child at UCLA got about $5,000 of scholarships and grants. And let's just call scholarships and grants in federal work study the free money that doesn't have to be paid back. You are all part of Debbie's audience, which means you are probably amongst the most well-educated on topics related to financial aid, scholarships, and grants. So I won't go into this in too much detail, other than to just give the 10-second summary of you fill out FAFSA. FAFSA results in a calculated number called Student Aid Index. The Financial Aid Office uses that to potentially give you a bunch of different versions of federal aid, state aid, and institutional aid, which just means if the school has need-based money that it can give to students and families, they use your FAFSA information for the most part, and CSS at some other schools, to allocate this to you. I won't go into all the details of how that gets done, but suffice it to say that this example family got $5,000 worth of scholarships and grants, which leaves them with a little bit over $38,000 left to pay towards the upcoming academic year. Now, some of you may have been on a previous webinar where Debbie and I discussed the ways that you could negotiate your financial aid. I'll give you the 30-second overview of this, and then I'm gonna just refer you to a video actually of the last webinar that we did going through this for about 90 minutes. Now, I'm going to focus just on need-based financial aid appeals, which means when you submit FAFSA, the financial aid office gets a view on your family's finances, but it's not a complete view. And you have the opportunity to appeal the results of your financial aid award, especially if you're able to provide new information to the financial aid office that they hadn't yet had the chance to consider. And if you'd like to go back and look at that video of the previous webinar, hopefully it will help you get a better understanding for the different types of reasons why you might be able to explain to the financial aid office that they should reconsider, while increasing the likelihood that they actually will give you more need-based aid. This is maybe not relevant to you this year, but keep in mind that you fill out a FAFSA every single year, which means that you get a new need-based aid package from the school every single year. And that's another opportunity for you to appeal those results in case there is a chance that you might be eligible for more than what you've already been providing. And so I would just say, whether this seems like it's relevant for you this year or not, keep in mind that this is part of your toolkit for paying for school over 4 years. You will always have a chance each year to appeal your need-based results. And there are many types of reasons why you may be eligible to do so. I'm going to introduce you now to a concept which you may already know, but after the scholarships and grants that you or your student have been provided, you're left with this $38,000 number in this example. And that is theoretically your borrowing limit, no matter where you'd be borrowing money from. And so if a school says at some point that they're not allowed to do something called certifying a loan above a certain amount, what they're doing is using the technical term that means the amount that you're asking to borrow is higher than your borrowing limit. An implication of this is if you get an external scholarship that is reported to the school, and many, if not most, are, then that scholarship would reduce your borrowing limit dollar for dollar. So the school is supposed to then take the information they have about that new scholarship you received, and they're supposed to add it into the red scholarships and grants bucket that you see in the middle of the chart, which then reduces the amount that you have left to pay from your cost of attendance and reduces the amount that they're allowed to let you borrow. So just something to keep in mind as you make financial plans over the course of the next year. If you end up getting some large scholarship and you already have a loan out, I would make sure to not overspend versus what the school is going to allow you to have. So second to last step on this process. Now we're after scholarships and grants. Hopefully we've maximized the amount that we're able to get, and we have to decide how we make payments towards this $38,000. And this is where the next step in the tree comes down to your savings and ongoing income. For this little example, I'm using $10,000 is what the family decides to contribute towards school for this year. For your own situations, it's going to vary significantly. Whether you have a 529 plan that you're planning to use towards paying for school, other savings, or excess income that you want to allocate towards paying for school for the year. One general piece of advice that I have is it can be helpful to try to use more savings from your 529 plans and other things up front in order to delay having to take out any loans whatsoever. I'm not saying that you have to do it. There's a lot more complicated analysis that you can do, and this answer won't be right for each person. But if you are able to not take out a loan this year and instead take one out next year, that means that you're going to be accruing less interest until you start paying that loan off. And so think about how much savings you have to pay towards college. And if you are able to, try to delay taking out loans if they're going to ultimately be needed. Again, for this example, the family used $10,000, and now they're left with roughly $28,000 as the gap that they have to fill. And we can define that now as the amount that they're going to need to borrow for the upcoming year. And there's really three sources through which they can do that. There's two types of federal loans, one borrowed by the student, one borrowed by the parent, and private alternatives to those products. And that's what we're going to get into for a majority of our conversation right now. Let me just take a quick look and see if we have any questions, and then we'll move on.
There was really just one question. Well, there's
Okay.
two. One about the 529s, which about can they be used to pay back student loans?
Right. I believe it's up to $10,000 can be used per person to pay back student loans.
And there's another question, Chris, about private scholarship money that was sent, in this case, directly to a student, as opposed to going to the college. And the parent is wondering if that money has to be reported to the college as scholarship money.
This is where things get a little bit gray, technically. In reality, the college typically doesn't really care all that much if you're reporting this or not reporting this. But there are some places that will ask you to attest to the fact that you've received X dollars of scholarships. And so in reality, you don't have to, but there's still some chance that the organization, even if they sent the money directly to you, could be reporting it to the college.
That's a good point. So you should, in this case, the family should ask the organizations that from which the student won the money, won the scholarship, was awarded the scholarship, if they're also notifying the college or not. And your best situation would be if they are not notifying the college and they sent you directly the check, then you should just cash it and use it towards paying the bill.
There you go. Speaking of that bill, the three options, we're going to go into this in a lot of detail now. And some of it might get a little bit too detailed, but I hope it ends up being helpful. So I'm going to just give you a quick overview of how the next 20 minutes is going to go. I'm going to give you roughly 2 slides worth of important information about each of the 3 types of loan programs that you should know about. And as we go through it, we're going to talk about a bunch of different financial things that I'll talk about on the next slide. I'll pause after each one to answer any questions related to these programs. And then I'll explain a little bit more at the end about how some of these programs might change starting next year. And I'm going to caveat all of that with, for those of you who are or who have children who are entering college this fall, you are supposed to be grandfathered into the current set of programs and rules that I'm about to walk you through. And so if you hear lots of changes in different news articles about updates to federal student loans and reductions in access to certain programs, just be aware that at least the way that text is currently written, those are not intended to impact students who will be in school this fall. They're grandfathered in for another 3 years after, but it would impact, say, a new set of rules for any other children you have who have not yet entered college. And I'll help explain what some of those are in just a few minutes. At a very high level, before we go into more specifics for each program, we're going to talk about federal direct loans, which are borrowed by the student themselves. And this is where you're going to be typically told to start if you do need to get any student loans at all, because they do have lower rates amongst the federal options, and they have a lot of protections built in. We'll go into a lot more detail about why I say that. If you need more money than that, that's when you would compare your Parent Plus versus private student loan option. And Parent Plus is just the name for the other loan that you can get from the federal government. Again, it's something that is only borrowed by the parent themselves. Student is not a part of that loan, but it is more expensive than the loan that the student is allowed to take out. Private loans are completely different than those in that a lot of those loans are typically co-signed by both the student and the parent, and the rate that you'd get charged on those is going to change depending on your financial background and primarily credit score. The rate on federal student loans is the same for everyone who qualifies, and we'll get into that in more detail now. So just quick overview again. For each of those 2-slide vignettes that I'll walk you through for those loan programs, we're going to talk about key things to know as well as these 8 factors. I'll cover what the origination fee is, if there is one, what the interest rate is, the type of rate it would be, whether it's fixed or variable, how much you're allowed to borrow up to, and then we'll also talk about how you qualify, whose name the loan is legally in, when you're supposed to start making payments, and what happens if you face some sort of financial hardship. And we're going to really start here with the federal direct loan. So as I was saying before, this is where you should start if you need any money to pay for college whatsoever. And the reason why, not just me, but I feel like any source that you look at would tell you to start here is, first, among the 2 federal loan options, this has lower rates. And I'll go into that more in a minute. But more importantly, there's a lot of different types of legal protections that are built into federal direct loans. While you're not allowed to borrow that much through this program every single year, these are eligible for public service loan forgiveness. If the student ends up going into medicine or teaching or a wide variety of careers that are eligible to have that loan forgiven, then these type of loans are able to be forgiven under those sets of rules. On top of that, there's a lot of protections that are built in case the amount that they're able to pay after graduation isn't that high. So they're able to set their payments to a rather low percentage of their income, meaning if their income is 0, their payment is also set to 0. So if money is needed, this is where to start. Key things to know. There's no cosigner who's needed. There's no credit check that's involved for a federal direct loan. If you filled out FAFSA, your school's financial aid office would tell you how much in federal direct loans you are eligible for. And we'll walk through the limits in a minute. This is available to all students who are eligible for FAFSA. And the origination, so let's go through the key things to understand. There is an origination fee, both on this loan and the federal Parent Plus loan. The origination fee on this is much lower than the second one that I'll tell you about in a few minutes. So a 1% origination fee does not mean that you pay 1% out of pocket. It effectively means that, to use the example from before, if you wanted to send $100 to UCLA, you'd actually have to borrow $101 through the federal direct loan program. And so it effectively just increases your principal by the origination fee. This 1%, not that large. Soon you'll see on Parent Plus, it gets a lot larger. So the interest rate on federal direct loans is 6.39%, and it's fixed rate for all new loans that are originated after July 1st. There are a lot of resources on schools' websites that will have a different number than what I've posted here. They're going to say 6.54. It's just because those are outdated. The updated number is 6.39. So federal loan rates are down by about 0.14% over last year. These loans are borrowed by the student. Only the student's name is legally on them. They're able to delay making any payment until 6 months after they graduate. And as I was mentioning before, there's no credit check involved at all with this. You may see on your financial aid award that there is a line that says subsidized federal direct loan or unsubsidized federal direct loan. And here's what that means. Depending on the results of your FAFSA, if you were classified by the financial aid office as having a high level of financial need, there's more complicated math behind it. You could have a portion of this loan offered to you on a line in aid letter that says subsidized. What that means is that it doesn't accrue any interest until after the student graduates. All other loans, which is most in this category, are unsubsidized, which means that they will accrue 6.39% interest starting from the day that the money is sent to the school. I see an excellent question from John, and let's cover now direct loan borrowing limits and one of the more interesting implications of how these work. So what you're going to see on this slide is the annual loan amount the annual loan limit that you can get for a direct loan as a student. And it really varies on two factors. One, what year is a student in school? And two, are they considered in the eyes of the Department of Education to be a dependent student or an independent student? You may already know this, but I'll cover it for those who don't. That designation has nothing to do with your taxes, and it has nothing to do with whether they're 18 or not. It's a very specific definition that's used by the Department of Education and aligns with basically whether or not the parent had to complete part of the FAFSA application. So if a student is independent, they can borrow more money than a student who is dependent. And the Department of Education counts people as being independent if they meet any of the following factors that you see on the right-hand side of the slide. So if they are at least 24 years old or married, a graduate or a professional student, a veteran or a member of the armed forces, an emancipated minor, and a couple of other designations, then they are considered independent and they're allowed to borrow the higher loan amount that you see on the right column of the chart. Freshman year, the student who's dependent can borrow up to $5,500. A student who's independent can borrow up to $9,500. If you get to your junior year of school and you have not used this program yet, you are still limited to borrowing $7,500 for your junior year. You don't get to use the unused portion of direct loan limits from your freshman or sophomore years. So another reason why, when this is available to you, it's a use it or lose it type program. Finally, and I'll touch on this again a little bit more in a minute, this loan program has no credit check involved, but Parent Plus does. And some people can get denied access to Parent Plus. If that happens, there is a process through which the student can get access to those higher loan limits that are available to independent students. And so I'll come back to a little bit more of how that works in a few minutes, but I'll pause and just see if we have any questions before I move on to Parent Plus loans. Repayment does not begin immediately on unsubsidized loans. So repayment on direct loans starts or is required 6 months after the student graduates or drops below half-time enrollment. So while interest does accrue, you don't have to actually start making those payments. If you'd like to, you can. There is no prepayment penalty. There's no prepayment penalty with any of the federal student loan products that exist, or with any of the private loan products that Juno typically works with, or that most lenders offer. So if you're able to pay off parts of these loans as interest accrues month over month, that can be a great way to avoid the principal amount spiraling out of control by the time somebody graduates in 4 years. And that really brings us to the first step of our, what I'm going to call your loan decision tree. And to me, this part is simple. It'll get more complicated soon. If your child is entering their first year of school, and the amount that you need to pay towards tuition is less than the amount that you're allowed to borrow through the direct loan, then you should just use that and you don't really need to move on. If you need more money than that, don't worry, because a lot of people do. And that's when you want to compare federal Parent Plus loans versus private loan options. And so for really the next 10 minutes or so, we're going to go into a lot more detail about how those two things work and what the trade-offs are between them. At the highest level, Parent Plus is great for a lot of people, in part because it does not have, as long as you qualify, everybody gets the same rate. And for a lot of people, that ends up being the best option. Private loans are going to have different rates depending on your credit profile, and sometimes they can be higher, and many times they can be lower than what Parent Plus offers. So let's go through Parent Plus first. As I was saying, this is something that you want to use after you hit that direct loan cap for the year. And it is only borrowed by the parent of the student. The student can't be legally added to this loan. As long as you qualify, you're going to get the rates that I'll walk through in a moment. And let's go through those key 8 factors. So first, you saw in the last loan program that there was roughly a 1% origination fee for the money that's borrowed by the student. Unfortunately, for the money that's borrowed by the parent from the government, that origination fee goes to 4.23%. To use the same example as before, if you borrowed $100 through this program, UCLA would receive slightly less than $96. The interest rate on these is also considerably higher than what you saw for the direct loan program for the student. So for any new loans that are originated after July 1st, they'll have a rate of 8.94% fixed. Now, the direct loan program only allowed a freshman student to borrow up to $5,500. This program really exists to help fill the gap of whatever remaining need the family has for that year up to the borrowing limit. So the borrowing cap is actually set to the borrowing limit, which, as a quick reminder, is your cost of attendance minus the scholarships and grants you received. The way that you qualify for this, there's a link in the next slide to the application. Your school's financial aid letter or dashboard would typically also just include a link to the application for a Parent Plus loan. It lives on studentaid.gov, which is the same place that you would have filled out FAFSA. And there is a very specific set of rules around how you qualify, but it has effectively nothing to do with your credit score. As long as you don't have something called adverse credit history, which I'll talk about on the next slide, then you can be considered qualified for the Parent Plus program. We'll go into that in a little bit more detail. But it doesn't matter if your credit score is 850 or if it's 600, as long as you don't have adverse credit history as defined by the Department of Education, you're going to get that same 8.94% fixed rate. One last thing that I want to cover on this before we flip in to the next slide is just a quick tip. So there are 2 payment types that are typically associated with the Parent Plus loan. In one version, which technically the default version, you're supposed to start making payments 60 days after the loan is dispersed. And dispersed is just the technical way of saying money is sent. You can request to defer making payments until 6 months after the student graduates. And you will have an option in a drop-down menu to select if that is what you want. Make sure that you select that if that is indeed what you want. Last note on Parent Plus, there are some protections that are built in terms of repayment plans and hardship, but it is significantly fewer than, and I'd say less helpful than what's available to a student directly. So just something to consider. Maybe the most common question I get is who exactly is eligible for a Parent Plus loan? And it is explicitly the parents of undergraduate students who are enrolled at least half time. Somebody else in the family who wants to help a child pay for school cannot get or use a Parent Plus loan to do so. So a grandmother or a grandfather, an uncle or an aunt, or somebody else, they can't use this program. Uh, and then probably the most common overall is understanding that the children can't get this loan added into their own. So they're not legally responsible for it. There's not a process by which the Department of Education can make them a co-borrower or a co-signer on it. And so if there is some expectation for the student to help pay towards this loan, it's a discussion that you need to have with them. And it's more of an agreement between you, but can't be one that is legally enforced through the loan program itself. If you want access to this, again, your school's financial aid website probably already has communicated this link. And if they haven't, you can click on here and apply here. I'll make sure to send this out tomorrow. We get this out tomorrow soon. And then as long as you get approved, then the next step is to do something called signing a master promissory note, also called an MPN. And that's basically just a digital signature saying that you understand that this is a loan, that you agree that you will pay it back, and that the information you provided is accurate. It's effectively a digital signature. Once you do that, then there's a process that happens kind of outside of your view where the school requests the amount of money that you've asked for from the federal government, gets it and credits it towards your tuition bill. If there's money left over after the required tuition and fees, then that money can later be transferred to your personal accounts for living expenses. I was mentioning earlier that there are a few reasons why you may be denied access to Parent Plus. These are just a few, but there's a longer list that is updated on the Department of Education's website. But the way they frame it is generally, if you've had recent bankruptcies, large debts that are more than 90 days delinquent, defaulted student loans of your own, or a recent wage garnishment or a tax lien, in addition to a few other things, that gets defined by the Department of Education as adverse credit history. And for those reasons, they may deny you access to the program. And again, if that does happen, then you can request that the student gets access to the higher loan limits that an independent student can, which again just means that for the first year of school, if the student was dependent, they could borrow $5,500. If they got reclassified as independent because you were denied Parent Plus, then they could borrow $9,500. It doesn't solve the full problem of necessarily how much you might have to pay towards the upcoming year, but it can certainly help. So for the Parent Plus loan, and I think this may be a common question. Let me just go through a few of these. So I have a question for you from Carrie on. Would a deferment request on a Parent Plus loan ever be denied, meaning the request to not make payments until 6 months after graduation? To the best of my knowledge, no. There's not a set of rules to qualify for the deferment request. Is it true, the second question, if the parent dies, the Parent Plus note is no longer due? Yes, that is true. There's death and disability discharge in that. The student isn't tied to it, and so that is true. And I see a question here that I might expand a little bit to just a general reminder that whatever repayment plan you select on Parent Plus or on private student loans, you always have the option to pay those loans back faster. There is no prepayment penalty that is associated with any part of the federal loan process. And so if you, let's say for Parent Plus as an example, decided to defer making payments until 6 months after graduation, but wanted to pay off the interest as it accrued monthly, then I would certainly recommend doing so if you are able to. And there is no penalty for doing so or anything to prohibit you from doing so. For the sake of time, I'm going to move on a little bit, and then I'll make sure to come back to anything that I may have missed. The way I would think about private loans is as a potential alternative to the Parent Plus program. So the key thing that I maybe have repeated a few times now is that these are priced based on your actual credit. And the price for someone with some version of credit could be very different from one place to the next. And so I want to give you a general overview of some of the key things to understand about private loans. I'd love to encourage you to shop around. And at the end of your shopping around process, I'd like to ask you to at least check what you'd be able to get through Juno, and I'll talk more about that in a minute. So most of the private student loans that are out there are co-signed by both the parent and the student. There are also sometimes options to get something called a private parent loan that is only in the name of the parent, but the vast majority of these are co-signed by both the parent and the student. It is the parent's credit history and income, if that's part of the underwriting criteria of a lender, that is primarily driving the rate that you would get. The student typically doesn't have enough credit history or any credit history for it to make a significant influence, if any influence at all, on the rate that you might see. At this point in time, most private lenders don't have an origination fee. As far as I know today, there is one private lender I can think of that has an origination fee, and it's only for international students. So I'd say the vast majority of places that you may see would not have an origination fee. None of the lenders that Juno works with have an origination fee. The interest rate is going to vary. And what I'd love to walk you through is maybe the 3 factors that can influence the rate that you might get when you apply for or check your rates for a private loan. So first is the term length that you would select. Second is whether that rate is variable or fixed. And third is when you choose to start making payments. You will typically see the option for a fixed or a variable rate. I'd rather strongly recommend a fixed rate. I can answer why if anybody has questions. It's more of a preference thing, but I would choose a fixed rate. Second is the term length. And so the term length is the number of years over which you agree to pay back. You typically will see lower rates quoted associated with a shorter term length. The longer the term length, typically the higher the rates that you would get from. And so those term lengths do range between 5 and 15 years at most lenders and 5 to 20 years at some lenders. The third thing is choosing when you want to start making payments. And you have 4 options there typically. The sooner you agree to start making payments and the larger those payments are that you agree to make, typically that's associated with some of the lower rates that you might get offered. Just let's use maybe a spectrum. So on one extreme, you can choose something called full deferment, which means you delay or defer making any payments until either 6 or 9 months after the student graduates. Those options differ depending on what lender you're looking at. In that scenario, the lender is not receiving any money from you until 9 months after the student graduates, which could be over 4 years from today. And in those scenarios, the rates that you might get charged or offered are on the higher side. On the other end of the spectrum, there's what's called immediate repayment, which is kind of like how most loans work. If you borrowed a loan on a 5-year term today, then in roughly 5 years, you should be done paying it off. You're making full payments on that loan starting next month. And those types of loans are typically associated with some of the lower rates that you might see from any given lender. In between, there's other options you can select. One's called interest only, where you're only obligated to pay off the interest each month, and then you start making full payments after the student graduates. And then the last option is typically called fixed payment or minimum payment. And I left it for last because it is many times actually the best. The way that works is, depending on the lender, you're typically required to make a $25 or a $50 monthly payment while the student is in school. But what that allows you to do is unlock something called an auto pay discount. So at this point, I think every lender has an auto pay discount, which is a 0.25% reduction in your interest rate on your outstanding balance once you connect a bank account and start making automatic monthly payments towards your loan. When you're doing that $25 fixed payment, that allows you to unlock that quarter point rate reduction from the very beginning of the process, which can make a meaningful difference on the total cost of that loan. Last thing I'll kind of leave you with here before we go on to the next slide. Private loans do not have the types of hardship protections or student loan forgiveness programs that are available in the federal direct loan for the student. And they are also less flexible in many ways than a Parent Plus loan would be. And so just keep that in mind. You can sometimes get a lower rate on a private loan than Parent Plus, but the trade-off is in part some of the flexibility that could exist with a Parent Plus loan. So let's talk a little bit about why you would consider using a private loan. Again, you'd only really look at this after the student has borrowed the most that they can from the direct loan, which again, that's up to $5,500 for a dependent student for freshman year. But there's two reasons why I commonly hear from parents that we speak with about why they're choosing a direct loan. The first is maybe fairly obvious. They're able to get a lower rate through the private market than what they've been offered by the federal government, and they choose to go down that path instead. The second is if you really want the loan to be in the name of both the student and the parents, because Parent Plus is only in the name of the student and it stays that way. It cannot be kept a federal loan and have the student added to it. The most important thing when considering whether to even look at a private loan, in my opinion, is to shop around, because you're able to shop around at most places today without doing a hard credit check, meaning without impacting your credit as you try to see what rates you might be eligible for. So most lenders at this point have something called an eligibility check tool or a pre-qualification tool that allows you to put in some basic information that typically takes around 2 to 4 minutes and see, based on a soft credit pull, which does not impact your credit, what rates you might be eligible for. And those rates that you'd see after that tended to be very stable and highly aligned with the rates that you would see after you would submit a longer full application. So just keep that in mind. You have a lot of leeway to be able to shop around without impacting your credit, and you're typically able to do that first piece of the shopping around in just a couple of minutes per lender. Now, I'm going to give you a really quick overview on how some of the things I just spoke about might change starting next year. First, if you're listening right now and you are going to school, or your children are going to school this fall, and you don't have other children who are going to school after this fall, in all likelihood, these changes don't apply. But if you do have children who are going to start college after this year, then the way that some text is currently written, the changes I'm about to walk through might apply.
So, Chris, can I just
Yes.
clarify that? Are you saying that for parents who are on here tonight as students with an incoming freshman, that they will have access to all of the loans that you just described in their students' sophomore, junior, and senior year?
The way, yes, as long as they borrow $1 from one of those two loan programs this year.
This year. So that
Yes.
I wanted to actually emphasize that, because that might be the only reason why everybody tonight might want to just borrow something from the federal loans this year, so that they can maintain the eligibility to access those loans in the coming 3 or 4 years while their student is in college.
Exactly. So the way that I've read it and talked to folks about it, as long as the changes that I'm about to walk through are going to impact both the direct loan program that the student can borrow as well as Parent Plus. And as long as, let's say, either of two things happens, either the student borrows some money from the direct loan program or the parent borrows some money from the Parent Plus program, then they are grandfathered into the same things that I just walked through for 3 years after this year. And so, put another way, the most important part of that is the parent would always have access to the Parent Plus loan program for this year plus 3 years, all the way up to the full cost of attendance. Now, the big changes that are potentially going to happen, I'll give you the 20-second overview of what we know and what we might know more, and then let's go into the changes. So first, what I'm showing you right now is based on the House budget bill that was passed a couple of weeks ago. So there's a really big budget bill that's going through Congress right now. The House has to pass a version, the Senate has to pass a version, and then they have to make those match. The stage we're at right now is the House has passed its version. The Senate is going to release, most likely, their version of the text that impacts student loans and impacts you next week. And we'll learn more over the next couple of weeks about what actually becomes law, but it's quite likely to be similar to what I'm about to show you. So 2 sets of changes, and then a couple of more that I'll touch on that aren't on the slide. First, there's a portion of the text that says that the loan limits for a student borrowing money from the government for undergrad would change. Currently, the student is allowed to borrow $5,500 for freshman year. That's going to change to the median cost of a program in the year before they go to school. We don't actually even know what that truly means yet because it hasn't been fully fleshed out. But the way it's being, the way to think of it is, if you are a journalism major at UCLA in 2026, 2027, and that's your first year of school, your loan limit is supposed to be set to the median cost of a journalism degree in the prior year across all schools in the US. And so loan limits might end up being different by degree for many different people. We don't yet know that because that data is not even published. I'd say ramification of that is, it seems more likely than not that the amount that a student might be allowed to borrow through the direct loan program would go a little bit up each year. It's not going to go dramatically higher because there's still a lifetime cap. A student would only be allowed to borrow up to $50,000 through the direct loan program for their entire undergraduate degree. The amount they may be able to borrow for an individual year could go up. The bigger change that's going to have more of an impact on the slides that I showed you until now is updates to the Parent Plus program. And so the way that things are currently written in text, currently there's no cap on how much you can borrow each year. It's whatever the school's cost of attendance is minus the scholarships and grants you receive. In the future, for people who are not grandfathered in, the way this bill says that there would be a $50,000 lifetime cap per parent. You could use that entire cap up in 1 year, but that's the cap. And it doesn't matter how many children you have, the cap is still $50,000 per parent. So that has significant implications for the ability to access funding up to the whole cost of attendance and whatever amount of need is actually left. And something that people just should be aware of and prepared for as you think about paying for college for children who aren't going to be in school this year. Let me pause and see if we might have any questions about this.
There's a few questions really about, and I don't know if we know for sure, to tell you the truth, about whether a parent and student need to take out a little bit in both a federal direct loan and a Parent Plus loan to be assured that they'll have access to those loans going forward, or if a student just takes out a federal loan and this year, will the parent have access to a Parent Plus loan in future years?
This is something I have checked twice, that technically the way that things are written, if a student takes out the direct loan, the parent would still have access to Parent Plus. But let me get a better, let's say, more thorough reading of that piece of it. And especially after we see what the Senate version says, which will most likely be on Monday or Tuesday of next week. And so I don't know if it would be helpful, but maybe I could send you kind of like a quick note with a reading of any changes that may have occurred in the Senate's version
That'd
of
be
that
great.
versus this, as well as the answer to that direct question.
And then there was another kind of comment, which I think is be worth kind of sharing so that we could kind of clear it up. Somebody has said, can we apply to the Parent Plus loan even if we weren't offered one this year? So the phrase offered one, I think, should be cleared up, because nobody's offered a Parent Plus loan, because everybody and anyone is allowed access to use one. So it might not have shown up on your, federal, on your financial aid offer, which actually would be good, because that meant that the school isn't kind of trying to say that you don't have anything to borrow, because that some schools kind of include that as a line item and confuse people. But anyone can use the Parent Plus loan.
Any parent of a student, yes.
Yes, sorry.
Yeah.
Yes.
Yeah.
Yes. To be, yes, correct.
Sure. Yeah. I see one question here I just want to make sure I touch on to make sure that I think there might be a slight confusion. And the question is, does a new cap help by keeping a limit on how much you're allowed to borrow so that your remaining need would have to be met by the school's financial aid? And no, actually. The school has no obligation to meet the amount of financial need that you have based on the results of your FAFSA and the school's cost of attendance. We've kind of been, in a way, lucky that the current set of federal policies makes it so that almost everybody has access to funds that are able to meet that full level of need. But under these changes, once you hit that cap, you hit that cap. And whether the school has some schools might have the ability to help you by reducing the amount that you need to pay them, but many schools won't have that financial flexibility. And so there would be more, I'd say, people applying for and looking at private loan options, but there also might be some downward pressure on school prices over time. All right, I'm going to bring the whole thing together really quickly with one example of why I think shopping around actually makes sense. And this is something that might end up applying even more so to you next year than it does this year. So in the example that we've been using, this Bruin has a $43,000 bill. After scholarships, they have a $38,000 bill. After they use their savings, they have to figure out how to borrow $28,000. And their first decision was the right one. They chose to use the direct loan. And so they got $5,500 through the direct loan for the student. And then they had to decide for the remaining $22,700 after all of this, how did they compare a Parent Plus loan versus a private loan? All I'm showing you here is a quick example of what the total cost of interest and fees would be for this family for the Parent Plus loan versus a theoretical example private loan at 8%. And look, your actual results might be very different than this. Your rate might be much different than this. But if you do the math out on that remaining amount, over a 10-year repayment window, the Parent Plus loan would cost $5,360 more than the private loan at 8%, which is a less than 1% difference in rate, but amounting to a pretty significant difference in the total amount of interest and fees. My takeaway from this is just to shop around and just see what you might be eligible for and use calculators to compare what the cost is all in for Parent Plus versus private. We have one on our site that a lot of people use that's up to date with the latest information. I know that there are many that are out there as well. I just recommend shopping around and comparing your options. Which really brings me to my last section, and then I'll turn it over for any Q&A that you may have. We started Juno to try to get people better offers on student loans. And really, we started it to see if we could leverage the concept of grouping people together and getting lenders to do something different for a group than they would do for an individual. What's available to you now on our site is first, the ability to check your rates in less than 3 minutes without impacting your credit score. And then second, a process that we've set up to try to make as many people as well off as possible who are looking for a private loan. The way it works is if you end up signing any loan through one of our undergraduate lending partners, then you get 2% cash back on your loan from Juno. So the $25,000 loan would result in a $500 digital check that we would send directly back to you. And if you shop around and you find a better rate from a very long list of eligible lenders, which you can very easily find on our site too, then we increase that cash back to 3% and we match that lower rate that you found. So the way we set this up really is for the express purpose of rewarding you for shopping around, of trying to make sure that we can give you, at the end of the day, the best possible outcome that would be available for you. And that rate match process is meant to be real and simple. There's no gotcha or catch to this. If you check your rates in other places and see what you like, at some point, check what you can get on Juno as well. If you want to match your rate, we have a set of instructions to follow, but it ends up being as simple as just, there's a tool you can use on our website. If you don't even want to use that, you send an email to hello@joinjuno.com. There are people who are constantly monitoring that inbox on my team, and they ask you for the right document to submit to claim the type of rate that you want to match against. Somebody makes sure that you're comparing things apples to apples, for example, a fixed rate to a fixed rate, a 10-year term to a 10-year term. And then we work in the background to make sure that your rate gets matched and that we process your cashback amount. It ends up being very simple. We are more than happy to help you one-on-one, whether on phone, Zoom, email, whatever, get that done. And I'm going to make you just 4 very quick promises before we go back to any Q&A. There is no cost to sign up to or to use Juno, not now and not ever. There's no hard credit check needed to see what rates you'd be eligible for Juno. There's only a hard credit check after you see rates that you like and you want to submit a full application to get access to those. Whatever options and partners that Juno works with, we set strict filters for them to have no fees, meaning no application fee, no origination fee, and no prepayment penalty, meaning you can pay any loan back faster if you want to, as well as a repayment option that allows you to defer making payments while you're in school. And whether you use any of the products through Juno or not, myself and folks on my team are more than happy to help almost 24/7 through any of the channels of communication that we have available for any question related to financial aid, whether it's about loans or grants or FAFSA or student aid index or something else. And so please don't hesitate to reach out. I lied, I have one more slide. Just the four most common questions overall about student loans, and these apply to both federal and private. Just something to keep in mind. First, do you borrow for 1 year at a time? And the answer is yes. You are not able to borrow for all 4 years up front. Even if you could, you wouldn't want to because you'd be borrowing more money than you needed and accruing interest for a long time on money that won't get used until later. Second is, can you change your repayment selection after you lock in a loan? And generally, no. Meaning, this is just something to be very careful about. If you're looking at a private loan and you select immediate repayments for a 5-year term, it has a very low, very attractive rate. 2 years down the line, you generally can't change your mind and say, okay, actually, now I want to delay making payments for a few years until after my student graduates for whatever reason. That is typically not something you can do. But the other way around, you can do. And so you can choose a 5-year term with fully deferred payments and decide, actually, right now, I feel really good about my finances and I want to start making a big dent on these loans every month. You can absolutely do that. And then finally, can you borrow from a different lender each year? Yes. One, I'd say, common hesitation that I might hear from folks is not wanting to have to make payments on multiple different loans to multiple different places, which I completely understand. I've been in those shoes and it's quite annoying. But I would still encourage you to shop around for 2 reasons. One, you may very well get an amazing rate from one place 1 year and then a much better rate from another place the following year. And second, there are many cases in which you can consolidate or refinance those loans into one larger loan with hopefully a lower interest rate after graduation, which can achieve the aim of simplifying where the money needs to go to and how many things to keep track of anyway. So with that, I will flip to Q&A.
Okay, there's been a question which I think is worth other people hearing about. If both parents need to sign for Parent Plus loan, or can only one parent do it?
Only one parent needs to. If that parent is denied, then you might want to try the other parent.
There's a question earlier on. Oh, about maybe just the timing of the question is, when are the funds dispersed? If school starts the first week of September, is there a grace period if you're waiting for a loan? And is it the family's responsibility to do all of this in the summer by July? So kind of, I guess, a little bit more, even if you explained it before, about the timing of when you apply, how long it takes to get approval, and then what happens after the approval.
It's a great question. Let me answer it this way. I think it might be helpful. So first, just general advice: each school has a different tuition due date. Those dates typically vary, or typically in August, somewhere in September. For some schools on the West Coast and Chicago, it's actually all the way in October. Your school's financial aid website should tell you two things. One, what day bills are created for the fall term, and two, what the due date is on those bills. It varies quite a bit across the board. What you want to do is work backwards from, let's say you find out what your tuition due date is, and then you work backwards from there to figure out how long you need to take or how far in advance you need to work to be able to pay that bill. The general advice that you're going to probably see in a lot of places is that you want to start at least 1 month out. And I think that is good advice. But if it is 2 weeks out of your tuition due date, you still generally have more than enough time to be able to borrow money and meet the deadline for that bill. Meeting the deadline for that bill is the responsibility of the family. And there, on many schools' financial aid websites will say that they would restrict the student's ability to enroll in class if the due date is not met or if it's exceeded by a certain number of days. So maybe the most conservative view you could take is, yeah, you could theoretically wait until 2 weeks before in most cases and be fine. But you want to start a lot earlier, and I'll get into why. Before I tell you why it makes sense to do things early, I'll answer maybe the second sort of question that's in this series of conversation, which is, how long does the process actually take? The process of checking your rates is typically less than 5 minutes, wherever you're doing it. After you see rates that you like, you would submit a full application. A full application takes anywhere from 10 to 30 minutes. It honestly is a little bit of a range. And so all of that can happen within the first hour of you starting this process. After that, you submit that full application. Then what you're typically waiting for is the results of that application. Are you approved or not approved? And what rates are you approved for? In the data that I was looking at yesterday, about 50% of people who get approved on day one. And about 96% of people who get approved within 3 business days. And so we can kind of think of this as, most of the time, you can get from starting to look at rates to being approved for a loan within 3 business days. After that, you only have one step that's left, which is, once you've been approved, you select which loan you actually want, meaning, do I want a 5-year loan, a 10-year loan, or whatever combination of the options that we were talking about earlier. And then you sign that. Signing it is an additional signature that basically just says, yes, I want this, I'll pay this back. Please tell the school that this is what I'm going to use. That lender, whoever they are, then the ball is effectively in their court and the financial aid office. So between first 3 days, in most cases, you can get all the way through to the point of having your job be done. Sometimes it can take a little bit longer if your situation is more complicated. But then after that, all that happens is that the lender contacts the school, say UCLA in this case. They ask, is Chris an incoming student at UCLA? Is the amount that they want to borrow less than or equal to their borrowing limit? UCLA says yes and yes, and please send us the money on this date. The lender then wires the money to UCLA on that date. If the amount that you are borrowing is higher than the tuition and fees that you owe for that term, then there's an overage. And then UCLA's financial aid office would reach back out to me and say, Chris, there's an overage. Log in here and tell us where you want that overage sent to so that you can use it for living expenses. So I'm not going into too much detail here, but the last part of this is the reason why I say it makes sense to check rates early is there's a little bit of optimization that you can do. The first thing to keep in mind is rates can change a little bit from week to week. And once you're approved for a loan, those rates are actually locked in for a 30-day window. And so you get approved for something, and over the next 30 days, if rates go way higher, you've locked something in that was lower earlier, as long as you sign it within that 30-day window. And if they go way lower, truthfully, you're able to check your rates again and lock in something that's lower, just not use the first one. And there's no interest that accrues until the money is actually sent to the school. So whether you do something now or you do something in August, your interest is only going to start accruing on let's say September 1st is the tuition due date, that's the day that the lender will send the money to the school, and that's when interest would start accruing. Okay, I'm done
Um,
now.
what about a student who doesn't need the money first semester but needs to borrow second semester? What's your advice about when they should secure that loan?
Great question. So you're going to see in most lender applications that you can select between three options for when you'd want the money sent. So let's just simplify this and say it's a semester program. You often have an option to say, I want this for the fall semester or the spring semester or the full academic year. And in that situation, what I recommend is you just select the spring semester. And I recommend you actually do that now. And if you do that now and you lock in rates that you like, if in 3 months, let's say the general interest rates in the market have gone way down, and you check your rates again, and you see, wow, I actually now qualify for something much cheaper than what I've already signed up for. The truth is that you can still cancel that before the money is sent to the school, and then just use whatever new rate you found to pay for the spring semester. Which brings up a slightly different point. I get asked this a lot of, do I apply for one semester at a time or the full year at once? You can do one semester at a time if you want, but it's for the same reason I just said, often just makes more sense to apply for the full year up front. You're not going to accrue any interest on the second half of the money until it gets sent to the school in the spring. And you've basically just given yourself the option of getting a set amount of money at the rate that you qualified for today, sent to you in the spring. And if you happen to find something that's a lot better in December, then you can cancel that second disbursement and get something better that's cheaper.
Good question. There's a question about do you have advice for a retirement age single parent? And I'll also combine that with somebody who asked earlier in the discussion about potentially using some of their retirement money, but it was unclear whether they were going to actually take distributions to use it or if they could borrow against a 401k.
Sorry, I missed the first part of what you said. It's just
Oh,
disconnected briefly.
okay, sorry. Somebody was just asking if you have advice for a parent who's of retirement age.
Good question. So one thing I'll point out is retirement. So just the thing to consider with private loans in general is that income verification is typically part of the process. Not always, but typically. And so even if you qualify for a rate from somewhere that's super low, just be prepared that retirement complicates things, and you're often asked for more types of asset verification that can be slower, but just something to be prepared for. Your process and your timeline might extend a little bit if you do seek a private loan in that scenario. Second thing is as you near retirement age, there are some interest rate, let's say you can deduct interest on a student loan up to a certain amount, but that phases out at not a very high income. In some cases, it can phase out if your retirement income is lower than when you were working full. You might be below that phase out when you're in retirement, and so you might get some tax benefit from this. But I can't think of anything else off the top of my head that might specifically apply to that scenario.
A question about repayment programs for Parent Plus loans. Did you talk about that yet, Chris?
Yes. And I see here there's a question. Is this the question about the 30-year term length?
Yeah.
So the standard repayment plan for a Parent Plus loan is a 10-year repayment window. It's the same for the Grad Plus loan too. So you, in I'd say most scenarios, would be making payments either starting 60 days after the money is sent to the school and finishing 10 years after that, or deferring payments until 6 months after the student graduates and then making payments for 10 years after that. There are some repayment plans that besides that you can opt into. Starting next year, one of the things I didn't touch on in that slide is that all of the repayment plans for new loans would be kind of collapsed into two. And if I'm remembering correctly, Parent Plus loans would have one repayment option where the number of years that you're required to pay the loan back in is tied to the loan balance itself. And I think it works out to, in most situations, still being a 10-year term. But if you see that, I think the 30-year number, the reason I mentioned this is you're going to start seeing some things in articles about federal student loan repayment timelines being up to, like say 25 or 30 years. And part of that is just tied to some things that are written in this text about another formula that defines how long you have to make payments for.
Yeah.
Yeah.
Can you use the loans for schools where the first-year freshman is outside of the U.S.? Because there's a lot of those programs now.
Yeah, you can. So typically the school has to be what's called Title IV eligible. And so again, it depends partly on the program. A Title IV eligible institution is kind of like a designation and a classification that's maintained by the government. I'll give you a quick example. We have a lot of Juno members that are using our products. They're from California or from North Carolina, but they're going to a couple of different schools in the UK and Germany and Canada and France and Spain. Those schools accept federal student loans, and they also are eligible for some private student loans. And so it's not a rule that as long as the school accepts federal student loans and it's Title IV, that you will be able to borrow private money to go there. But it makes it possible that there may be lenders who would allow you to borrow money to go there. Debbie, I actually have a question for you because I've seen this question a few times, and there are differing opinions on it around at what point in paying for college would you recommend emptying a 529 account?
It has a little bit to do with what the household income is, and kind of and taking advantage of the American Opportunity Tax Credit. But if that's not something you can take advantage of, then I'm trying to think. I would.
Sorry to put you on the spot.
Yeah. No, I would actually think of I love spreadsheets. I would really do a spreadsheet and kind of like fool around with the numbers. If you're going to, it depends, it's this trade-off between, do you borrow for another year? You know what I mean? It depends what the rate is, or do you, and do you, lower your borrowing? The problem here is that we're forecasting interest rates. You know what I mean? Or you're guessing at what the interest rates are. So, if we could say, well, the interest rate is going to be whatever it is today, for the next 4 years, that's like one assumption. But if interest rates are going to increase in future years, then there's a trade-off of, do I save some money for a future year and and not have a certain dollar amount at a higher interest rate versus having an extra year of a loan at a lower interest rate.
Very fair.
So I honestly, I can't give a straight answer. I think you kind of, if you feel comfortable with a spreadsheet, I would kind of do 3 or 4 different scenarios of how you would use that money. Whether, obviously the first obvious one is use it all in the first year and not have to borrow, maybe if that's the case, or spread it out a little bit. And then I would, in this crazy economic world that we're living in, I unfortunately feel that interest rates may be, on the rise in the next year or two. So that's what you're risking.
The one other, I'd say, maybe side to that I think to a little bit sometimes is I completely agree with what you just laid out there. The potential flip side is if you, depending on what your student aid index is, if you are lower income and don't have a lot of assets besides that 529 plan, that you have a large enough 529 plan, it can result in a student aid index that gets you access to very little in federal aid that doesn't have to be paid back. But if you, let's say, are able to materially deplete that 529 plan this year, the next year when you're filling out FAFSA again, you would have much lower assets that get reported, and then potentially a really low student aid index, which could get you access to a lot more free money. It's not a scenario that's likely or common, but it is one I've come across at least a handful of times, and just something to consider.
Chris, there's a question, and I'll kind of broaden this question. It says, we're still waiting to hear from scholarships. Do we wait to apply until we have the accurate amount we need to borrow? And that actually is a similar question a lot of people ask. Do I have to wait until I get the actual tuition bill, or the bill from the college with the final amount, or can I start the borrowing process now without having that final dollar amount?
Fantastic question. And this is typically how I think about it. If you start the process anywhere right now, so first, you don't have to wait. And if you start the process right now, it would be to your benefit to slightly overestimate what you might need, because there would then be two mechanisms through which you could drop it down to match whatever you actually do need. First, if whatever amount you're, let's say, approved for and signed is higher than what your borrowing limit ends up being, then it automatically gets reduced to that borrowing limit, automatically. Once the school communicates to the lender what your borrowing limit is. Second is, again, there's no prepayment penalty. So I'll tell you just a common thing that a lot of the graduate students who use Juno do is, right now, I think like 100 people applied yesterday, and with the intention of, if they ended up borrowing more than what they were going to ultimately have to pay, just basically returning that money the day that they get it, since there's no prepayment penalty. And the reason why people are doing things like that is just to be able to lock something in now and preserve the option of trying to find something better later. I'm not saying that you need to do that, but that's how some people are thinking about it. The last thing on that train of thought is, if you don't know how much you're actually going to need yet, and most schools have not yet sent out their actual tuition bill, it's also just perfectly fine to wait until you do. But if you wait until after July 5th-ish or so, then just from what we've generally seen, a lot of lenders will reprice the loans that they're offering in the market. A bulk of all of the people who are shopping around and looking for things happens in July. Rates sometimes do shift a little bit in the second week of July and beyond. And so if you want to wait, hopefully you would have some sense of what your actual bill would be before the end of June, so you can at least shop around then before things change. That's not always true. It's not true for every lender, but overall, on average, it's true.
Oh, somebody's asking about going back to the 529. Is it true that a 529 disbursement in year one counts against potential aid from the school the following year, therefore waiting to be use it as a junior, senior may be more beneficial? Carol, I'm going to guess that maybe you've been around for a while. That used to be the case, but with the changes in the most, I guess it's now been like a year and a half, the changes in FAFSA, that's no longer the case, that 529 distributions don't count against the aid. It's not basically they no longer count the 529 distributions as income for the student, and that's what they used to.
Yeah. And maybe just to add to that, if there's a 529 plan that's owned by somebody that's not the parent, so I'd say uncle or aunt or grandma or grandpa have a 529 plan, the student is a beneficiary, that doesn't even show up in any of this calculus. It doesn't impact the student aid at all. And so just something a quick reminder to consider. Will purchasing a new build as a primary residence affect the student's financial aid for sophomore year? So the sophomore year financial aid application, which is going to be primarily driven by FAFSA, will not include the value of your primary residence as an asset. Your primary residence is always excluded as an asset. And so let's just say theoretically, it has nothing to do with whether it's a new build or not. But if you happen to have $200,000 of cash that was in an account this year that you reported as an asset, as you would have needed to, and then all 200,000 of that went as a down payment towards your primary residence, then next year when you're filling out FAFSA, it's as if that $200,000 doesn't exist. It is invisible to the application, and just on those parameters, your student aid index would go down.
Chris, is another question that comes up a lot with parents that have more than one child in college at the same time, or particularly if they have twins or multiples going in the same year. Are they getting separate loans for each student?
They are. So the money is sent to the school for each student. So it would end up being a separate loan for each student. I see a question here that I want to make sure I understand a little bit better. As before I do that, yes, the same parent can apply for the loans for each student. It can make sense to alternate depending on each credit that each parent's the other debt that they have on their credit report, as well as, let's say, their credit scores. Again, this is very dependent on each person, but if there's one parent who ends up borrowing 4 years worth of parent plus or private loans on their credit, if their income isn't high enough, then that debt as a ratio of their income could make it harder for them to qualify for loans in future years. And so sometimes people do swap between which parent might be involved in that process. But again, very situation dependent.
Chris, there was a question further up. If you take out a private loan and agree to the $25 a month, does that increase in each semester? For example, does it become $50 a month at semester 2? And then if you sign with a new lender the next year, is that another $25 a month on that second year loan?
This is a great question, and it's why applying for a full year loan can be better than one semester at a time for this specific situation. So if you applied for a full year loan and you did a $25 monthly payment as the selected option for what you were required to pay while the student is in school, then you're paying $25 for per month through that first year of school. If you borrow another loan in sophomore year, that's that same type of loan, then yes, you would add another 25 to that. So for year two, you're making $50 a month payments. And then if you keep doing the same thing, this stacks on like that. But if you do it semester by semester, it would actually double up again.
Okay. I think you've gone through a ton of information, Chris. And what I want to say to everybody is that as you get started in the process, of course, you might hit other questions or other roadblocks. As Chris mentioned, you can reach out to Juno. They have people who can answer questions that come up. We also have some more sessions scheduled with Chris. We call them AMAs. We really, I guess, should call them AUAs, Ask Us Anything. And where you can come back. We run like these Zoom/meetings like this, and you can ask your questions. Actually, you unmute yourself, you ask your question directly, and we've done this a few times, and we'll spend like an hour and a half just answering people's questions. What's also really helpful is honestly you listening to other people's questions, because you might hear something that you hadn't thought of as an issue. So the point is, from here going forward, if you have questions that need to get answered, we're here to help. Juno's here to help. Either going directly to Juno, coming back to another one of our sessions, and actually in a few weeks we have as part of the Paying for College 101 group, there's a separate chat which Facebook lets you do, and we dedicated one of the chats to just student loan help, and Chris or people from Juno will be on that chat as well to help answer questions. So lots of ways to make sure that you can get your questions answered.
Thank you, Debbie, for hosting again. And thank you, everybody, for making it this evening.
Absolutely. Thank you, Chris. And we'll see everybody around in the internet, on social media,
See you soon.
and through email. Bye.